In 1815, a single courier crossed Europe faster than any army. He carried one piece of information. Napoleon had lost at Waterloo. And one banker, Nathan Mayer Rothschild, received it hours before the British government. By the time London learned of the victory, the Rothschild network had already moved the market. Stocks fell, then soared, and from that chaos, a family fortune became a continental power. That is how the story usually begins. But the real secret was never the message. It was the system that delivered it. While kings built armies, the Rothschilds built information routes. Private, silent, faster than the state. They turned intelligence into currency and trust into a weapon. This was not luck. It was architecture. By mid-century, their network linked London, Paris, Vienna, Naples, and Frankfurt. 5 brothers, 1 code, no borders. When governments needed loans to fight wars or rebuild after them, the Rothschild signatures turned promises into cash. And here lies the paradox. Every empire that borrowed from them became both stronger and more dependent. Debt flowed like water, clear, invisible, indispensable. It filled the pipes of Europe's political system, and no one noticed who controlled the valves. Some historians call this the birth of modern finance. Others, the quiet capture of sovereignty through credit. Both are right, because when nations traded autonomy for liquidity, the banker replaced the general as the real strategist. And the Rothschilds understood this earlier than anyone else. 2 centuries later, their name still stirs suspicion, myth, admiration. But behind those emotions hides a structure that never disappeared. It only changed its instruments. What began as family correspondence evolved into the DNA of today's global financial system. The same logic, different tools. And the question remains, who truly governs money? Those who print it or those who lend it? At the dawn of the 19th century, Europe was not a map of empires. It was a map of debts. Wars no longer ended with territory, they ended with obligations. Every major power owed someone. And beneath the noise of cannons, another kind of battle was taking shape, one fought with ledgers, not guns. After 2 decades of Napoleonic wars, treasuries were exhausted. Britain, Austria, Prussia, and France had bled their reserves dry. Gold was scarce, paper money was distrusted, and armies still had to be fed. The problem was simple. Without capital, even victory became a liability. The old mechanisms of royal finance, taxes, tributes, and spoils, were too slow for industrial war. Europe needed speed, secrecy, and confidence. That is the world the Rothschilds entered, not as conquerors, but as translators between states and markets. Mayer Amschel Rothschild, the patriarch, began modestly, trading coins and collecting rare currency for princes of Hesse. But he understood a truth that few of his clients saw. Information moved faster than gold. If you could know prices, alliances, or defeats before others, you could shape outcomes instead of merely reacting to them. By sending each of his 5 sons to a different capital, London, Paris, Vienna, Naples, and Frankfurt, Mayer built what no monarch possessed, a financial nervous system. Letters traveled through private couriers, coded and sealed. Each branch acted independently, yet coordinated like a single organism. Money could be moved across borders in hours, long before telegraphs or railways. When others waited for peace treaties, the Rothschild network had already positioned itself for the next crisis. Governments soon realized what this meant. They could borrow discreetly, avoid public panic, and fund wars without the approval of parliaments. A Rothschild loan was not just money. It was a political instrument. The terms were strict, the interest fair, but the real value lay in reputation. If the Rothschilds backed a bond issue, investors followed. Their name became a guarantee stronger than any royal decree. In London, Nathan Mayer Rothschild turned this model into machinery. He financed Wellington's army, transferred subsidies to allies, and used couriers to move gold where ships could not. In Vienna, Solomon managed the imperial debt. In Paris, James became the banker of kings. Each brother built a piece of the European balance of power, through loans, not bayonets. And behind their success stood one invisible principle: neutrality. They lent to enemies on both sides, not from disloyalty, but from calculation. Stability, after all, was more profitable than victory. Some contemporaries found this shocking. Others found it genius. But history tends to remember the surface, the wealth, the palaces, the myth of control. What it often forgets is the architecture, a system built to outlast governments, revolutions, and wars. It worked because it relied not on force, but on trust, the most fragile, yet most renewable resource in the world. From the ashes of feudal finance emerged something new, private capital as a public power. And as the 19th century advanced, the Rothschild network became the template for an age when banks would act as states, and states as clients. The old Europe of crowns and dynasties was quietly replaced by signatures and seals. The paradox was set. The more nations borrowed, the less sovereign they became. And the family that understood this paradox first would, for a century, hold the silent key to Europe's stability and its dependence. If this gave you a new perspective on how financial power replaced political power, tell me where you're watching from. By the middle of the 19th century, the Rothschild network had become almost mythological in its efficiency. 5 brothers, 5 capitals, one invisible infrastructure of credit. Kings came and went, the signature remained. But the very system that made them indispensable also contained its own flaw. Because when trust becomes a product, it can vanish as quickly as it appears. Europe's stability rested on paper promises. Bonds, issued in one capital and sold in another, were backed not by gold and vaults, but by the assumption of repayment. That assumption depended on peace. Yet peace in the 19th century was only an interval between crises. Revolutions broke out in 1830, again in 1848. Empires shifted, currencies devalued, and rumors moved faster than armies. The Rothschilds found themselves balancing not between borrowers and lenders, but between chaos and order. Their power was never absolute. It was conditional on credibility. And credibility is a fragile currency. When revolutions erupted across Europe in 1848, telegraph wires cut and governments collapsed, the network faced its first true systemic test. Vienna was in flames. Paris was paralyzed. For the first time, the family's system of communication, letters, couriers, coded dispatches, began to lag behind the events they were built to predict. Information, their greatest weapon, had met its limit. But something deeper was changing. The 1848 revolutions were not only political, they were financial. Crowds didn't just attack palaces, they attacked banks. Money itself became a target. And when confidence collapses, even the strongest houses can shake. For the Rothschilds, this was not simply a market panic, it was an existential threat, because their entire empire was built on the belief that they could not fail. In London, Nathan's successors managed to maintain control. The Bank of England still relied on their liquidity. But in Paris, James Rothschild faced hostility from a new force, the rise of public banking. The idea was spreading that national credit should belong to the people, not to private dynasties. It sounded democratic, but it was also dangerous. Public banks depended on governments, and governments depended on votes. Credit was about to become political. The Crimean War, 1853 to 1856, accelerated the fracture. Once again, nations needed money faster than they could tax or save. The Rothschilds financed both the British and the French, but now they were not the only ones capable of doing so. New players emerged, the Barings, the Hottingers, the national treasuries experimenting with paper emissions. The monopoly on trust began to dissolve, and with that came the real problem, the birth of central banking. It was subtle at first, cooperation between states and large private houses to stabilize currencies. But every new central bank reduced the Rothschilds' relative power. The mechanism they had pioneered, private coordination of credit across borders, was slowly being absorbed by the state itself. The system had learned from its architects. Still, their influence remained vast. They shifted from overt financiers of war to discreet managers of peace. They underwrote railway expansion, industrial projects, and national loans from Spain to Russia. Yet the structure of money itself was changing. Gold, once the absolute anchor, began to face competition from paper instruments and speculation. The invisible battery of debt was growing faster than the gold reserves that backed it. This imbalance would define the next century. By the late 19th century, the Rothschild network was no longer a mystery. It was an institution. Governments consulted them before issuing bonds. Their emissaries attended diplomatic congresses. But the power to shape nations was shifting from families to systems. The logic they had invented, transnational finance, was now self-sustaining. It no longer needed a name. And that, paradoxically, became the family's new dilemma. They had created a world in which financial interdependence was inevitable, but in such a world, even they could not remain untouchable. Panics became global. Markets reacted faster than any correspondence could travel. Control was slipping, not to rivals, but to the momentum of the system itself. The crash of 1873 confirmed this. Triggered in Vienna, it rippled across Europe and America, a depression born not of war, but of speculation. The Rothschilds survived, but the rules had changed. Now wealth could evaporate through abstract forces, rumors, rates, expectations. The age of information they had once dominated was turning against them. Some historians see this moment as the true turning point, when finance detached from human control. Others call it evolution, the transition from private empires to institutional capitalism. Either way, the Rothschild model, fast, discrete, transnational, had become the blueprint for the modern financial world. Their innovation outgrew them. In a sense, they were victims of their own success. The system they built to manage risk became the very engine of systemic risk. The bond market, once a tool of stability, now amplified instability. The private network of trust they designed was replaced by public networks of speculation. And through it all, one truth remained. Every crisis was an echo of that original design. A global web held together by confidence, not by law. The Rothschilds didn't lose power in a single moment. They diffused it into every institution that borrowed their methods. By the time the 20th century began, the family's name had become less a symbol of control and more a reflection of a system that no one, not even they, could fully master. The age of the banker had transformed into the age of the system, and in that transformation lay the quiet, unspoken cost of progress. To understand the scale of Rothschild power, one must first understand its mechanism. It was not about vaults of gold or secret conspiracies. It was about timing, information, and design. A network so efficient that it became a prototype for the global financial system itself. Imagine Europe as a circulatory system. Gold was its blood, but gold moved slowly by horse, ship, or rail. The Rothschilds found a faster medium, trust. They created private credit instruments, letters of exchange recognized across borders. A Rothschild note in London could be redeemed in Vienna, Paris, or Naples. This allowed money to move without moving, invisible liquidity across a continent still divided by borders and languages. Their couriers were not messengers, they were arteries. Encrypted letters, coded prices, and early arbitrage operations formed a synchronized rhythm. If gold prices rose in Paris, Nathan Rothschild in London could react within hours, long before official news arrived. The system worked because it ran parallel to the state, faster, leaner, and without bureaucracy. Governments borrowed from them for the same reason investors do today: predictability. When the Rothschilds issued a bond, it sold. When they refused, markets trembled. They had turned reputation into monetary policy. But unlike a central bank, they bore the risk themselves. That risk was calculated, quantified, and diversified across 5 financial capitals. The method was mathematical, early portfolio theory, long before the term existed. Each branch acted as both a bank and a censor. Vienna monitored the empire's creditworthiness. Paris read political moods. London managed the flows of gold and foreign exchange. When one market tightened, another provided relief. It was a living mechanism, balancing itself through correspondence and calculation. And then came the innovation that solidified their dominance: syndication. The Rothschilds realized that no single lender could sustain the scale of 19th century borrowing, so they invited rivals into cooperation, forming loan syndicates where multiple banks financed governments under Rothschild coordination. In doing so, they neutralized competition while preserving leadership. This structure became the model for modern investment banking consortia. Their influence extended beyond finance into diplomacy. A nation that defaulted risked isolation. A nation supported by Rothschild credit gained credibility on the world stage. Ambassadors negotiated peace, but bankers defined its price. Some ministers even consulted the Rothschild offices before addressing their parliaments. Money had become the invisible language of politics. But the system had one more layer, a psychological one: confidence. The Rothschilds cultivated it meticulously. They rarely appeared in public debates, avoided ostentatious wealth displays, and spoke through markets, not manifestos. A calm tone, a discreet transaction, a timely loan, these were signals. Their restraint created mystique, and mystique became influence. Technically, they were performing a function we now call liquidity management. Practically, they were shaping the rhythm of Europe's economy. They could ease crises by extending credit or tighten them by withholding it. In that sense, the family operated like a decentralized central bank, with one critical difference: no one elected them. Their legitimacy came entirely from performance. And yet, this mechanism was not infinite. It depended on stability, on governments honoring debts, on information remaining exclusive, on markets believing that private wisdom exceeded public authority. As communication accelerated, telegraphs, newspapers, speculation, the edge of secrecy eroded. Information, once their private weapon, became everyone's commodity. And when information is democratized, control fragments. Still, the Rothschild architecture endured. Its components, cross-border settlements, syndicated loans, liquidity corridors, and reputational signaling became the skeleton of global finance. Today, these same mechanics power central banks, rating agencies, and global bond markets. Only the names changed. The logic stayed intact. The family did not merely finance Europe, they engineered the blueprint of financial globalization. The paradox is elegant. By perfecting the private network of trust, they made the public network of markets inevitable. Their creation outgrew them, just as every invention outgrows its inventor. Every mechanism carries a cost. The Rothschild system was no exception. It gave Europe stability and dependency. It financed wars and the peace that followed. But every transaction had a shadow, a long-term price written not in gold, but in sovereignty. By the late 19th century, nearly every major state in Europe owed money to private bankers. Budget deficits became permanent, interest payments institutionalized. A new kind of monarchy was born, the monarchy of credit, and like all monarchies, it demanded tribute. The Rothschilds themselves remained discreet, preferring partnership to domination. But their network set the precedent that governments could live on borrowed time, indefinitely. Debt became a resource, not a danger. It fueled railways, canals, industrial expansion. It built modernity. Yet it also bound nations to their creditors with invisible chains. Each new loan postponed collapse and deepened dependence. This was not exploitation, it was equilibrium. States received liquidity, investors received yield, and the system grew. But equilibrium is fragile. The more efficient the network, the greater the shock when it breaks. The first global test came in 1873, the so-called Panic of Vienna. A speculative bubble in railways burst, collapsing banks across Europe and America. Credit froze, confidence vanished. The Rothschilds survived, but the aura of invulnerability cracked. The lesson was mathematical. Interdependence multiplies risk. When everyone is connected, no one is insulated. In response, governments began to centralize. National banks gained power, currency policies tightened, and gold became the standard of discipline. Ironically, the very system the Rothschilds had built, international, flexible, fluid, was replaced by rigid national frameworks. The age of the family banker yielded to the age of institutions. Still, the imprint remained. Every bond market that emerged, from London to New York, carried traces of the Rothschild design: underwriting syndicates, multi-state loans, secondary markets. Their method had become the law. And when the 20th century began, with new wars on the horizon, those same instruments would be used again, but now on a planetary scale. World War I confirmed the shift. No family could finance a conflict of that magnitude. Only central banks, backed by governments, could print the money needed. But even as the Rothschilds' direct role diminished, their logic endured. Finance first, politics second. Nations that could mobilize credit survived. Those that could not disappeared. In a way, the Rothschild story marks the transition from personal capitalism to systemic capitalism, from a world ruled by names to a world ruled by numbers. They were the bridge, and they paid the toll. By the interwar years, anti-banking sentiment grew. The same qualities that once symbolized stability, secrecy, coordination, transnational reach, now inspired suspicion. Propaganda twisted the family's legacy into conspiracy. The myth of omnipotence overshadowed the reality of structure. It was easier to blame a dynasty than to confront a system. But history's irony is quiet. The Rothschilds lost the spotlight just as their architecture conquered the world. Every modern treasury, every international bond market, every coordinated rescue during a financial panic, these are descendants of their model. The name receded, the mechanism became immortal. The consequences were not moral, they were structural. A century of dependence on credit redefined what nations could and could not do. Sovereignty became relative, tied to bond yields and interest rates. Power shifted from ministries to markets, and behind every policy stood an equation: cost of borrowing versus cost of rebellion. The Rothschilds had shown that influence does not require domination, it requires predictability. Their quiet discipline outlived their presence, and as the 20th century unfolded, it became clear that their true legacy was not wealth, but the normalization of debt as the engine of civilization. Debt built cities, armies, and industries. It also built dependence, inequality, and crisis. Every benefit had its mirrored cost. Every empire financed on credit carried within it the seeds of its decline. The mechanism they perfected worked too well. It turned money into motion, and motion into necessity. Once the machine was running, no one could turn it off. If this helped you see how balance always hides its own instability, tell me where you're watching from. The century turned, the names changed, but the rhythm remained. Then it was called debt finance. Today it's called monetary policy. Different language, same mechanism. Credit still moves faster than law, and trust still decides the fate of nations. When the Rothschild network dominated Europe, information was a privilege. Now it's a torrent. Markets react in milliseconds. Algorithms replace couriers, and central banks have become the new dynasties. They speak in coded statements, each word shifting billions. The press conference has replaced the private letter, but the effect is identical. One signal, global response. Look closer at the structure. In the 19th century, governments borrowed from private houses. In the 21st, they borrow from their own central banks. But the transaction is the same, illusion of control. Money is created from promises, not production. Bonds are still sold, interest still accumulates, and confidence remains the only real collateral. History didn't end. It digitalized. Consider the 2008 financial crisis. Lehman Brothers collapsed, confidence evaporated, and the world rediscovered a forgotten truth. Interdependence multiplies fragility. Just as in 1873, the system froze not because of lack of assets, but lack of trust. And once again, salvation came from coordinated liquidity. This time from the U.S. Federal Reserve, the European Central Bank, the IMF. Public institutions doing privately what the Rothschilds once did discreetly, lending stability to restore belief. Quantitative easing, the modern euphemism for debt expansion, is the logical heir of the 19th century loan syndicate. Instead of 5 brothers, there are now 5 continents. Instead of couriers, there are data lines. But the mechanism is unchanged. Inject credit, suppress panic, delay collapse. The invisible battery of debt keeps the global machine running. And like all batteries, it must be recharged through inflation, taxation, or time. The mirror is perfect. In the 1800s, the Rothschilds built a private web that outpaced governments. Today, digital finance has built a global web that outpaces regulation. Cryptocurrencies, shadow banking, derivatives, they all replicate the same pattern of distributed control. Decentralized, but not necessarily democratic. Every innovation widens access and obscures responsibility. Who owns the risk when everyone shares it? Some historians argue that the Rothschild era was the prototype of financial globalization. If so, we are now living inside its perfected version. The supranational institutions, the World Bank, the IMF, the BIS, function as modern equivalents of that original network, neutral, technical, indispensable. Their language is different: stability, liquidity, sustainable debt. But behind the jargon lies the same principle: confidence management as a form of governance. And yet the paradox deepens. The more governments intervene to stabilize markets, the more dependent markets become on intervention. The same loop that began 2 centuries ago still spins, faster, broader, riskier. Debt creates growth. Growth demands more debt. Central banks act as both firemen and architects. The crisis is not an event anymore. It's a condition. Then it was gold reserves. Now it's digital reserves. Then it was panic in Vienna. Now it's volatility on Wall Street. But the emotional core is identical: belief. Investors believe that central banks will act. Citizens believe that currency will hold. Governments believe that trust can be managed. The entire edifice stands on psychology, disguised as economics. And behind the numbers, one echo remains from the Rothschild model: discretion. Modern monetary authorities rarely speak plainly. A hint, a pause, a single phrase, for as long as necessary, can move global markets. Language has replaced gold as the store of value. Words are the new reserves. There is one more reflection in this mirror: technology. In the 19th century, the Rothschilds used private couriers to move information ahead of rivals. Today, high-frequency traders use microseconds to do the same. Speed still equals power. Delay still equals loss. The same race for advantage continues, only now the battlefield is invisible, measured in code and latency instead of horses and ink. Finance remains an arms race, only the weapons changed. And the deeper lesson? Every system built on confidence must eventually face disbelief. When the promise of stability itself becomes the product, it cannot be infinite. The Rothschilds understood that and diversified before collapse. Whether modern institutions can do the same is uncertain, because this time, there is no external banker to call. The system must rescue itself. What began in Frankfurt's narrow alleys as a family network now lives in global balance sheets and algorithmic trades. Its logic governs pensions, mortgages, currencies, and deficits. It has no single owner, no clear antagonist, no exit. The architecture is complete. The question is no longer who controls money, but whether anyone truly does. 2 centuries after a courier raced across Europe with news from Waterloo, the message is still the same: whoever controls information controls value. The names changed, the instruments evolved, but the logic never disappeared. Credit, trust, timing, the silent trinity of modern power. We no longer speak of dynasties, only of markets. But markets, like dynasties, have memory. They reward the patient, punish the reckless, and obey the same invisible law: belief precedes reality. The Rothschilds didn't invent it, they revealed it. Money moves not because of gold or paper, but because of confidence in tomorrow. And now imagine if every bond, every digital transaction, every national debt is just an echo of that original correspondence between brothers. A network built on letters became a planet wired by algorithms. History didn't vanish, it scaled. The myth of the family endures because it contains a truth about us. We seek stability, yet we build it on promises. We demand control, yet we trust systems we no longer understand. Every era hides its bankers behind new symbols, palaces, skyscrapers, screens. But the mechanism remains. Debt as motion, information as leverage, trust as empire. In the end, the untold story of the Rothschilds is not about a family, it's about a pattern. One that began with couriers and continues with code. History doesn't repeat itself, it compounds.